I think if you look at the pool of VCs here, you will have different expertise across the board. No single VC needs to have all of that above. Are we willing to make a bet that might hurt us, that might hurt our own business? And are we willing to force that down the throats of our operating companies? That requires top-down support. It's going to get blocked otherwise. The other way around, also to say, if it's too strategic and it's just because the management wants something that will help them deliver and execute because they can't do it internally, but that doesn't really create a financial return. The good news of being independent and having that top down is the ability to say no.
Joining me on the couch is Kushal Shah. He is the managing director of EN Capital.
Traditional business stays on the lower risk appetite kind of playbook where we're protecting our margins, we're protecting our revenue base. I'm talking about telco. And then we have new business units like mine, or like, call it the AI unit that we will talk about in future weeks and months to come. Those are all disruptive, new to the world, where we will accept that the timeline is different, the risk reward profile is different, the type of activities we do are different, even from an internal kind of shared services perspective.
Looking to sort of build my career in venture capital. Why would I come to you guys as CVCs? Welcome to today's episode of Couchonomics with Arjun. Joining me on the couch is Kushal Shah, or as we all like to call him, Kush. He is the managing director of EN Capital, which is part of the EN group, or what some of us in the UAE might know as Etisalat. Actually, I bumped into him last week in Marrakesh, but practically only bumped into him for a nanosecond. He's a hard guy to get hold of. So I think the team has done well to get you on the couch. Welcome, Kush.
Thank you. Look forward to this.
Excellent. So Kush, the way this show is structured, and I hope you've tuned into at least one of the episodes because we're soon coming to about 100, is this is as much about having a conversation between you and me, but also actually imparting a bit of knowledge, right? Because most of the guests who come here, or actually all the guests who have come here, are people who are kind of the best at what they do. So I'm really keen that we end today's session with the viewers having learned and heard a little bit more about what corporate venture capital is all about, what EN Capital is doing, and so on and so forth. But let's start at an abstraction, because I know you've, like me, were previously in consulting. You've been an angel investor for years in this market. You're closely associated with a number of VCs. What's the state of, if I may say, venture capital or investments in the region?
So I would say it's probably roughly 10 years old. So we've done a full vintage of a typical life cycle of a fund. So if you take some of the original VCs, they're probably in fund 2, 3, 4, which means they've had enough time to show TVPI, DVPI, etc. over a period. There's a lot of maturity in the market. So rather than talk about the amount of capital that's currently deployed or dry capital, let's talk about what's the maturity. Now, in terms of maturity, we see multiple things. On the founder side, we're getting to see multiple repeat founders, both locally as well as internationally coming here. So in that sense, the supply side is fun across all series. So at the early stage, kind of a little bit later stage, even late, when I say late, I'm talking about A and B, coming from abroad, but replanting themselves here locally. So that gives a lot of new vibes to the market. So
what you're saying is that the deal flow is there and is actually a quality deal flow.
It is attractive deal flow.
Okay.
So that's one part of the maturity. The second part of the maturity is that the VCs are becoming a lot more picky, partly because of the amount of funds they have, but second, they've learned, they've been through the cycles. So they learned, so they're becoming a lot more picky where they deploy, how much they deploy, what kind of deal structuring they do. So all of that maturity is healthy, super healthy. We are also seeing some of the impact of the unhealthy structures that happened a few years ago. So those are kind of going through their kind of restructuring efforts, and you see all sides of it. You see some sort of legal constructs happening. You see down rounds. You see zombies, you see, a whole range of events happening in that space, which is also healthy because we can only learn from that.
So if I sum it up, you're saying the Middle East is increasingly representing a microcosm of what's actually happening in the world, right? Anything particularly unique here?
There's a whole bunch of uniqueness. So obviously there is some specific geography uniqueness, whether it's Saudi, Egypt, UAE. You have each one has its own specificities, including the amount of capital, including the type of VC sitting there, including the development support that comes with it. So Saudi, as most of you are aware, you would have the development funds, the SVC plus JADA, providing a lot of support to the VCs, plus also direct, and that shows, and it has impact. I think UAE is a bit different. That's a little bit more natural. And Egypt, there was the macro issues that people had, which is changing. I think the currency situation is stabilized. The ability to take money in and out has stabilized a bit more. So I think what I'm seeing is the drip feeding back into Egypt has restarted. So there was a gap of about 18 months where Egypt was a vacuum, and now it's restarting again.
No, it is, and actually, what I found quite interesting was that when we were in Marrakesh, which was for GITEX, there was a number of funds who had their events and their soirees, and you saw a number of Egyptian sort of startups, right, whether they were fintech or otherwise, who were there, and you're right. I think that drip feed is increasing. Let's switch gear. Let's talk a little bit about corporate venture capital, right? It's not a new term. It's been going around for years, and was actually, I don't know who made it very famous, but it first came into my radar when Intel and others sort of created a corporate venture capital. Google did it, so on and so forth, right? Tell me, how do you sort of distinctively differentiate between corporate venture capital, right, and venture capital without saying the obvious difference that exists?
So I would say, from a purpose of setting up a CVC for almost everybody, not just us, there's a big purpose of sourcing two things: sourcing new trends and being able to understand how those new trends will impact our own or the corporate's own activities, and then being able to actually potentially acquire inorganically some of those. So if you look, sometimes you have CVCs, or sometimes they act as LPs in other funds.
I was going to say, yeah.
Where they use it as deal sourcing for acquisitions at some point. And I think that's, both of those are relevant. It also, the third point, which is not a direct purpose, but it happens a lot, is it shakes up the organization internally, because you see what's coming from outside. Sometimes it's cannibalizing, sometimes it's disrupting, sometimes it's just watching new technology at play. It does impact the way the organization sits. So transformation is part of that, and this is given a little bit of separation from the processes and organizational structures that can be hurdles. So they see something which has a bit more oxygen compared to internal, and then that allows for a shake-up.
But Kush, if I just take this from an academic perspective, right? You read a lot about CVCs, and you typically say CVCs tend to opt one of two strategies, right? Either they become strategic, and I guess from what that means is they are there to deliver greater strategic value to the mothership that they're a part of. On the other hand, there is a spectrum, right? And Microsoft's a great example. There are a couple of others who typically tend to primarily focus on financial returns, right? They're not so bothered about strategic. Do you still see that chasm, or do you see more hybrids coming through? Especially from a context of the region.
I'll go back a little bit.
Sure.
I think the CVC concept over the last 3 years has grown substantially. So we're not the only ones that have set up in the last 2 years. We've got several banks setting up.
Yep.
We've got property guys setting up. We've got energy companies setting up. So you've got CVCs as a concept increasing. So that spectrum of how their mandate works is quite different. The risk-reward mandate, the strategic versus financial, it's not the same for everybody. In our case, which we can get into later, I would say we're probably closer to the financial, but I'll explain that a little bit more. There are aspects where you say, depending on what strategic elements or verticals you're focusing on are typically close to your heart. Why? One, you want to see what I described earlier, those trends go through. Two, it's where your expertise lies. So as a CVC, we always turn back to some experts in-house and say, hey, we've got this great company. There's some technical areas we need validating, or some commercial areas we need validating. We can call upon experts that nobody else from a VC perspective would find easy to do. So that expertise also comes in, and that also brings some championing of those companies. And the third is you also provide a potential fuel in terms of customer base or market size, because we become potentially a customer of that startup.
But if you just use the three terms, right? You said sponsorship or championing.
Yeah.
You said access to expertise that sits within the firm or within the corporate, and you also mentioned the fact that we could become a fuel, right, or into it. Doesn't that sort of take you further into this sort of world of becoming a strategic CVC, right? And then my question to you, the real question to you is, everywhere I read, they say, successful CVCs tend to need autonomy, right? How does that fit? Because here is dependence,
yes,
which is quite pronounced, and it's across the entire life cycle. So identification, validation, integration, and then post-integration support. But at the same time, your autonomy. So how do you guys sort of balance the two?
One, it's very difficult. And it goes around in cycles.
Yep.
Sometimes you're autonomous, and maybe 3 years later, and I've asked this question to all my predecessors in CVCs across the world, especially telco CVCs across the world, and they've run through cycles where they're fully autonomous, then they're less autonomous, they were fully financial, then they are fully strategic. So there is no right or wrong answer.
Right.
It is not easy.
Agreed.
Number one. Number two, top down is important. So you must have support from a board, executive, management, so that some of these hard decisions, which, going back to the word cannibalization or disruption, it will hurt the existing operation or will force transformation of the existing operations. These are part of the risk appetite. These are part of the transformation journey of the corporate. So that top-down support is necessary. So, for example, at the point of investing, are we willing to make a bet that might hurt us, that might hurt our own business? And are we willing to force that down the throats of our operating companies? That requires top-down support. Mm-hmm. It's going to get blocked otherwise. Mm-hmm. The other way around, also to say, if it's too strategic and it's just because the management wants something that will help them deliver and execute because they can't do it internally, but that doesn't really create a financial return, the good news of being independent and having that top-down is the ability to say no. Mm-hmm. My deal flow, not just my deal flow, I think most CVC deal flow not only comes from the market, also comes from internal sources. Mm-hmm. And very often you have to say, pretty much 99% of the time, you have to say no to the internal deal flow in a polite way. Yeah. But you need that support.
Because they're trying to solve their problems rather than actually make an investment.
Yeah.
Okay.
Yeah.
So Kush, you mentioned that CVC, the stars are aligning, right, for CVC, right? But let me kind of go a little bit deeper on this. You said deal flow is getting better, higher quality deal flow. Let me put you on the spot. Is that largely international businesses setting up shop out here, or actually domestic startups too, right? And I'll be honest with you, my bias and my exposure is more towards the financial services world, so I know less about it. But what's your view? Are we really seeing quality startups come out of the region which merit, I guess, an equal consideration to ones which are overseas?
The timing, the impetus on the current timing is amazing. So I'll talk specifically UAE post-COVID. I'll talk also the timing of the talent flow that's coming, etc. So a few things. As we described at the very beginning, the maturity of the VC business means you now have an acceptance of risk-taking, acceptance of failure. You have an acceptance of ESOP programs, acceptance of carries, etc. So organizationally, the boards and remuneration committees are accepting that there's a different way of incentivizing. That's one thing. And there's also a different way of allowing failures to happen. So that is something that's a culture change. That's allow the VC industry and all the news and media around it, including your podcast, allow that maturity to happen. So that's good news for us. Second, post-COVID and the Golden Visa program, and also what Saudi is doing to attract talent, we've got a huge influx of technology talent, whether it's engineering talent, product talent, deep tech talent. Surprisingly, if you ask me this question pre-COVID, I would say we have a gap. I don't say that we have a gap anymore.
Okay.
That talent has arrived.
That's excellent.
Strategic talent always sat here. There wasn't a problem with strategic talent. There wasn't a problem with ideas. There wasn't a problem with where to throw those ideas in terms of the TAM. The market existed. The question was, could we build it fast enough?
So now you have built an execution capability.
You can.
Yeah.
And also the flexibility to do it on the cloud rather than on-prem, the flexibility to have cross-border, etc. I'm not saying passporting and elements of that are there. There's still regulatory hurdles. So I'm not getting into that. But the fact that a lot of those borders have been broken allows for local startups, international startups, and a blend of that. So the hybrid is working.
Okay. Now, you talked about talent. Let me talk about talent specifically in CVC, right? Yeah. You obviously need to build your teams. There are a number of VC firms coming up. There are private equity firms coming up. Banks are getting into the action. Why would someone actually go and work for a CVC?
Well, first, how do we communicate to the startups and ensure that they want to work with us? Mm-hmm. And what does our talent do to do that? Obviously, similar to a VC, we have to create value, not just provide the money. The fact that most of the CVCs have a very deep pool of customer base, a very deep pool of buying power, procurement power, that is something that attracts the startups. Mm-hmm. And that's what I call the in-kind, not just the cash, the in-kind value we create. So the talent on my side, on the CVC side, needs to be able to not only be financially strong, technically strong, but also be able to be, from a consulting perspective, I'd say socially able to integrate that back
into
home.
The business, yeah.
Right. And there needs to be a little bit of a telco angle in my world.
Yep.
In the banks, it'll be a banking angle. So there's a little bit of a deeper dive in those verticals to be able to provide that. That's not easy because obviously the people we're building the synergies with have a day job, which has a different KPIs, a different way of looking what they're doing. On our side, we have to really encourage that synergy. So the talent pool we look for is not exactly the same as a VC talent pool. It's slightly different.
No, I agree. But Kush, let me challenge that a little bit, right? So my bugbear with VC, right, over the last 5-10 years, a number of markets has been their shallowness in terms of actually understanding a business and its applicability, right? A vast majority of VCs, apologies for me, run in a herd mentality attitude, right? You see a particular sector or you particularly see a subsector, one investment happens, everyone's like, oh, should we also get a piece of that action? If not at the same company, let's go to the next company. Nobody really is able to give post-investment support, which is beyond just, sound financial advice. And even that has not been very sound. Otherwise, we wouldn't have seen such crazy runs towards just growing the top line and not bother about what happened. The correction that we talked about when we started the discussion is that the VCs are getting more mature. Part of that maturity is that they're now starting to say, we need to get a bit better around the automotive sector if you're going to have a lot of automotive startups or telcos and so on and so forth. But the talent is still finite, right? You're all going after that same talent. Now, I understand that you have a huge bench that you can lean on, which is within the business. But my question is, if I'm, which I'm not, if I'm a 25, 30-year-old looking to sort of build my career in venture capital, why would I come to you guys as CVCs?
So one, it's a very attractive industry, whether it's CVC or VC. So
yeah,
attracting talent pool globally, not just locally.
Not a problem.
This is not a problem. Now, number one. Why us? I'll park that for a second. But to get back to your point around the VCs, even each individual VC has a different profile that they're good at. Let's put it this way: at the very early stage, they're very good at spotting the people, very good at spotting the founders and getting a feeling for that founder. At a much later stage, let's call it almost private equity stage, it's very good at the financial side. Completely two different discussions. In the middle, we'll get into product, we'll get into technology, we'll get into the unit economics, etc. So there, let's call it the growth hacking kind of VCs. I think if you look at the pool of VCs here, you will have different expertise across the board. No single VC needs to have all of that above.
Agreed.
We're trying to sit in the middle of this.
Okay.
So we're trying to sit in the middle. So one, we have to describe what that job profile is to the talent that's coming to us. Many think it's only about going and searching for only deal flow and then quickly doing a deal. That's not us. That might fit other VCs. That's definitely not us. Many think it's deep financial evaluations. That's also not us. So those two elements, you have relevant profiles of companies for that, or VCs for that, or investment basis for that. We're quite hardcore, more operational. We spend a longer time on the due diligence. We spend the underlying companies will take we take the lead when we invest. We typically write terms which are a little bit tougher than a typical VC. And usually even after signing everything, we're still double checking. So it takes 2.5 months, 3 months. It doesn't happen in 5 weeks. And sometimes it happens in 6 months. And sometimes we just monitor and be friendly, and it happens after 1 or 2 years. So the companies that come to us have to accept that, and we're quite open and transparent about it. So if you want a fast deal and you want somebody to drive it, it's not going to be us.
It's not going to be. Yeah. Let me come back to you. I think you triggered a good, interesting thought in my mind, right? So VC is growing in this part of the world, or investments are going, because there's so many other products which are now out there. It's not just about VCP, right? CVC is growing. Do you see CVC growing faster than VC as a rate of growth, both in terms of deal count and deployed capital?
So it's slightly different, again, risk appetite discussions. VCs typically have a 10+2 life cycle. So 10 years or 2 to 3 years of investing, then following on. So call it 5 years, they've done the investment. And then they try to sell over the next 5 to 7 years. And then they have multiple funds to continue deploying capital. So their LPs expect drip feeding returns over years 4 onwards, and then by year 10 they expect a full bang return. From a CVC perspective, depending on which CVC, it could have a longer maturity. It could have a different style of maturity, like an evergreen play, where there is continuous cash put into the investment cycle without having to go to a new LP. It can also have the situation where, and that's what I expect, that maybe 2 out of 20, 10% of the portfolio companies are acquired ourselves. So we acquire our own companies. So there we'll obviously have to have a discussion around at what valuation, given they're buying it from ourselves. So I think that will be different in terms of the role CVC will play in the size of the total industry.
Okay, so let's now come to EN Capital, right? Because I think we flirted with the idea for long enough, right? So let me ask you the first simple question, in the sense that, what is the mandate?
So today I would put the mandate as both strategic and financial. We're not going to do a deal if it doesn't make financial returns. Most VCs will want a few fund returners or 100x's. We're not going to push that aggressively for 100x's. We're happy with the 10x. We're very happy with the 10x. But we do expect, well, the mandate in this particular scenario is we'll make about 20 investments. We've already made 15. So we'll make 20 investments in the current size of the pool, and then we'll add more funds into it. Each investment is roughly $10 million. So that basically, you can do the maths.
You can do the math.
So we're typically taking the lead. We're typically writing the biggest check of a Series A or a early B. It's geographically, it's worldwide. So we're not focused on a single geography. We typically want some synergy back, so some relevance to telecom. Now, if I take out of my deals, there are some deals that are heavily telecom driven. and some deals which are more, we can use our customer base to support.
And what are those
companies.
like? So from an adjacency perspective,
Yeah.
what are the interesting adjacencies that you guys are going into?
So I would say 3 very specific adjacencies. Anything connectivity driven, where, for example, there's an IoT play or a consumer play, connectivity driven.
Okay.
So, for example, our investment in Aerolo, which is the eSIM company,
Yep.
that's a pure...
We were talking about it as we came into the room.
Exactly. So that's that is telecom.
Okay.
Um,
But if I play this back, to me, they all seem strategic in nature.
those 3 were the strategic I highlighted.
Okay.
If I take the other extreme,
Yeah.
where we're basically adding value through our customer base, we've invested in a company called TradeStream,
Okay.
which changes the way trade finance is, the amount of time banks take to manage trade finance documentation, etc. There's very little synergy to what we do from a telecom perspective, but there's good synergy to what our customers want, what our enterprise solutions are around, etc., etc. So that's more a go-to-market synergy.
Okay. And from a geographic perspective, you said very interestingly, you're global in your perspective.
Yeah.
Does global mean regional with a few sort of global ones, or are you genuinely global in terms of your deal search?
The deal search starts locally.
Yep.
What happens is often we find global companies which are relevant to us because we're going to use their tools, or so the reason we would invest in the US or UK, Europe, Asia is typically because we're going to use that product.
And would you take a lead on those also, or you tend to come in as on the support side?
On those, we typically let somebody else take the lead because the local knowledge is important, etc. So usually we don't take the lead.
And have you guys twinned with people? Are
Yes.
there like your usual sort of friends
Yes.
who you tend to go with?
I wouldn't give names, but you have some logos up here.
Okay.
So yes, we work both with brands,
Okay.
large brands, very large brands.
Right.
We also work very closely with a few regional VCs.
Okay.
We also started to work with international VCs, the Peak 15s. So I'm not going to put out names, but yes, we do twin.
Okay. And so again, I was reading about this average holding period, and I think you mentioned about long, but I think increasingly CVC holding periods are decreasing, right? I was reading somewhere that it's kind of like 3 to 4 years now. Do you guys?
Very difficult. I think in the VC world, anybody who says 3 to 4 years, not going to happen. Private equity maybe,
Yeah.
or pre-IPO, etc.,
Yeah,
etc.
yeah. But even for late stage players like you, right, who are
We're not that late
that
stage.
you're not. Obviously, you said Series A. And
Yeah.
But is the intention to go further and further later in stage, or is the thought that as you become bigger and evolve, you're going to start taking more, I guess, greater risk in terms of idea risk and see earlier stage startups?
So in the E&, world, we also have an M&A bucket. So what often happens is when we really like a company, you saw Kareem,
Yeah.
Beehive, when we really like a company and we really think there's a lot of synergy we can work with, the flywheel works together. It might come through our process, the CVC process, but then it we pass the bucket to the balance sheet, which effectively moves to the M&A bucket.
Okay.
So there we would take 50%, 51%, or a path to control discussion like Stars play as well. So those have a different process, a different detail, diligence, etc.
And you guys get involved in that?
We initiate it sometimes.
Okay.
It comes through our deal flow, but it passes on.
It passes on to the M&A team.
Exactly.
Right. And so this is where it becomes interesting. Walk us through, so how do you remain autonomous as Ian Capital, but at the same time serve the need of E&, as a group? But give me an answer more operationally, right? So how does the governance really work in this? Where do the crossovers come from?
So E&, has put a spectrum of risk appetite.
Right.
Traditional business stays on the lower risk appetite kind of playbook, where we're protecting our margins, we're protecting our revenue base. I'm talking about telco. Those are all disruptive, new to the world, where we will accept that the timeline is different, the risk reward profile is different, the type of activities we do are different, even from an internal kind of shared services perspective. Do our legal team or our HR team or our procurement team understand the left side of this risk curve? They don't necessarily understand the right side. So we're dragging them into this version, which has very different requirements, very different SLAs. Some of that will drag, but some of them will actually accept and say, listen, we're not there to serve you. Get somebody external to deliver that, or hire your team to deliver that. So that is a equation that we're still grappling with, that we're working on. There's no black and white answer to that.
I guess it's over a period of time. You guys will mature, you
Yeah.
learn how to work together. So let me then put you on the spot here, right? As you said, and a number of banks are setting up their CVCs, right? And I think a lot of their interest is largely in terms of the sort of emerging fintech scene. I think a lot of them are realizing that, as you said very correctly, innovation from within is very, very hard. Corporate experimentation is the way forward. And possibly they're also using their CVC arms as a de-risking technique, right? In terms of, if they're going to invest into an early stage fintech, which is going to power, let's say, for example, their wealth management platform, they don't want to be in the hands of
crypto.
Crypto. They don't want to entirely be left to the wares of the the three smart kids who kind of created the business, but they want to invest. Give us sort of you've gone through. Is it a couple of years you've been in this role?
2 years ago.
2 years, right? I remember, 2 years ago we used to bump into at the Meridian every week in Riyadh, right? And that stopped about 2 years ago. Although I do miss bumping into you. 2 or 3 things that you would recommend, anyone setting up a CVC, especially in a very traditional environment. Let's be honest, as savvy as banks might want to behave, they're not the savviest bunch of
and it's not just
people.
banks. We're talking about very large energy companies, etc.
And rightly so, right? There's regulation, there's control, there's there's 100 years of legacy, so on and so forth. So what are
so one, getting a very clear mandate approved with the DOAs, DOPs, etc. So it's very clear what decisions can happen inside the CVC and what need to happen outside, and having a separation of those two. That, I would say, that is critical. On the decision making, because if you have to rely on the same decision making process as the traditional business, you're going to go through a business cases till rigor that won't work. So number one, setting that up. 2, getting that top down support, which allows for tough decisions to be made, even when they can disrupt. And 3, usually the first 2 or 3 deals, it takes time to find that kind of very attractive deal that the expert likes, because it's really in their home comfort zone, but they know they cannot deliver it internally, which also has a lot of market return, market upside, financial upside. So bringing that first 2 or 3 deals, which work on both the financial and internal synergy, I think that's critical. Because if you get the first 2 deals wrong, you're probably locked out.
You got it locked out. So let me add 2 other points to it.
Sorry, last thing is a dedicated pool of capital. Because if the balance sheet...
I agree with you. Part of that mandate, is having a dedicated pool. Otherwise, you just keep going back, asking for money and justifying before you even make an investment. I totally agree. 2 other aspects, right? For anyone setting a CVC from scratch, right, or starting something else, how important is it to build a network of third-party relationships around it to sort of get it going, right? Because my view is there is a certain risk around, building the whole, building the Colosseum and then nobody arrives, right? Second question, and I think the more interesting one, and we haven't still got into it, and I'd like to, is post-investment involvement, right, from a CVC perspective. But first answer the first one, and then we'll get into the second one.
Part of the first one is also, and maybe that's to your previous question, one thing we did, and that was important, and I'd recommend it, is avoid legacy. So some CVCs will say, hey, by the way, we're setting up a CVC, and here's some old companies we did invest, good or bad, let's throw them into that pie.
Okay.
So avoid that legacy, both in terms of old investments, but 2, in terms of the people. So we're a brand new team. We came in brand new, straight. Yes, we understood the organization. We worked with the organization as consultants or different ways, or we knew people in the organization. But having an existing team with a legacy product already brings you back, drags you back into the old side. So part of that, just to go back to the previous question.
Sure.
Working with the external ecosystem, I think, is critical, because it's not just about deal flow. It's important to have that for deal flow, and obviously 99% of the time in deal flow, you're still saying no, but somebody's helping you say that. Somebody's giving you filtering, because if we had to analyze 1,000 companies, we don't have the time, or even with AI, we don't have the ability to deliver that. So usually you shortcut that by, making a few referral calls. So for example, what do? I go and ask my top 10 VC friends, please share only your top 3 companies. Don't share me the tail end unless it's super relevant for us. So those kind of discussions. And very often they come across companies that don't fit their world, but fit our world.
But fit your world, yes.
But they really, they've done the filtering process. Mm-hmm. That is important, because now you start to trust each other. And it's a game theory. You don't do it once, twice. You do it 10 times. And it repeats, and you only repeat it with the people you're comfortable with that historically have given you good karma. That's one part of the ecosystem. The expertise required, I remember most of this is technologically disruptive, and very few people understand it in its early days. A lot of people understand it 6 months once the media has attacked it, but at the beginning it's difficult. So you need experts out there who are touching and spending time on it. 3, doing reference checks on the founders, doing reference checks on the customer base and the user fit is very critical. And sometimes those reference checks are phone calls. They're not much more than a 10-minute conversation. Mm-hmm. And I can tell you the number of times in my private life where I ignored a negative reference call, it came back and bit me.
Okay.
A negative reference call is almost a no-go for me. Mm-hmm. So those are all part of the ecosystem partners. And then going back, partnering with deals, sometimes it's not good. For example, Aerolo, there are about 10 telcos involved. I was willing to write the full amount, the full check that they were raising, but they insisted that they were, we agreed to put at least 5 new telcos into the cap table. So working alongside other telcos, working with those partnerships, it's key. Because as they say in Over the Top, you prefer to have 100% of the market than, just my share of the market. So that I think is key.
So let's talk about this sort of post deal or post, I guess, cutting of the check involvement. How do you guys manage it? How do you guys select which companies need a little bit of TLC? Yeah. And how do you resource for something like that?
So right now we're a 6-people team, including myself. We have in the portfolio of 15 companies, roughly 6 or 7 board seats. So shared between the partners, Eddie and myself, for example, and Samar. So there are 3 of us that are sharing those 7 board seats. We often have observer seats where we're not in the decision making, but we're monitoring and watching what's going on. And we have, of course, information rights across all 15. We're not going to take a board seat across the board because sometimes it doesn't make sense as well. That's 1. 2, we, on a regular basis, either the company is asking for support or we're noting that intervention is necessary. Mm-hmm. And so you step in and out as necessary, and it changes by company profile. In a portfolio of 15, I would say we've got the full spectrum. We've got some that need support on really let's manage costs, let's focus, and some which are growing so fast that they're breaking at the growth level. So, let's build. We need more executives. We need more management. We need more product support, etc. Because it's really growing too fast. So we got both extremes, and our support comes in there. Sometimes on the regulation side, there are some areas where you do need let's call it a big brand and a big budget who actually understands how to look into those regulations. Very often on breaking some customer base. So some large customers, be they banks, be they especially local entities, they struggle to do business with startups, even if the startup is already doing 10, 20, $30 million totally. In business. But when we join that and we provide an extra support, we're anchoring the deal or playing some sort of prime or behind the scenes support, it changes the game. The conversion rate improves.
Okay. So if I put you on the spot one final time regarding E and capital before we zoom out, what do you see as your big challenges in the next sort of couple of years to sort of continue with this? I guess you have 15 done, 20 more, then I guess you go back and ask for more money, right? But what are the big challenges that you see for Ian Capital?
So as we grow the portfolio base, the amount of effort, I mean, a typical VC will work 90, 100 hours a week. As a 6-people team, as the portfolio grows, I think it's difficult to manage a portfolio with a small team. So we're going to get stretched. And we're going to have to build a team, get a bigger team, and or we're going to have to allow some of our portfolio companies to have less support. So that kind of discussion will happen.
Or will you zoom out to becoming more of an LP?
So they're not more of an LP, but more of just an observer. Correct.
Okay.
So that might happen, but that's a challenge because that's not our DNA. That's not what we set out to do. We set out to really add a lot of value. In some cases, we will purposely hold back. And that's the natural part of this, number one. Number two, as we go back to call it our financiers, which is basically my CFO and the board, and say, hey, now as an evergreen fund, we're year 4, year 5 into the fund. Let's put new capital. They'll obviously look at the history and say, how is the performance? The performance on paper versus the performance on distributed income. These discussions will come through. Have we exited any? And are we exiting too early? So for me, they're too early versus I'd rather hold on. That discussion, and we have a live discussion in that scenario, that is what makes it very fun but challenging.
But I agree, and this is so. Where do you actually see most of these exits will happen for you? Are these going to go into secondary market? Is that where majority of your exits will happen? Are you guys going to full, as you said, a full acquisition and then just ingest it, or are these the IPO? And again, you'll say all three, but where do you see the current portfolio of 15 heading?
I mean, now I have two scenarios which are easy to talk about. One is basically private equity groups looking at it, all very excited.
Right.
So that's a discussion on primary, secondary, on the private equity side.
Right. You don't see many IPOs coming through.
Not at this stage.
Not at this stage.
No. I think that's another 2-3 years out.
2-3 years out. Right. Last question, Kush. We'll zoom back in. I think we touched on it earlier in today, which is, why is now the inflection point for CVCs to sort of grow in this part of the world, right? What's changing? Is it great deal flow? Is it because there's so much technology change? Is there so much capital slushing around with the large companies that they're saying, hey, let's go and use our capital? Is it the fact that people are thinking that, the worst is behind us after the COVID and the revaluations, and I guess valuations are more attractive, and therefore there is that upside, all of the above? But what's your take on it? Why is it getting all?
Let me put it very simply. AI, number one.
Right.
Where and I'll make this up, and I'm making up live.
I was going to say, could we have made it through this whole conversation without talking about AI? But
this situation. If I had to build a telco today,
right,
a traditional telco, and I used AI. Brand new. Imagine if Ian didn't exist. Imagine if Do didn't exist and we were building operator number 2 or operator number 3. Bottom up, I build it AI native, cloud native. It's going to have a completely new customer experience.
But I'd say that's the same about banks, right?
True. Yeah. Fintech, same.
Yeah.
I was using our example.
Yeah, okay, all right.
And that's CVCs. So because AI is going to enable a challenger to set something up, if it had enough capital and enough regulatory support and all of the above, to really attack the way they do business. Now, it's very hard as a legacy to try and force that AI into the day-to-day. Maybe there's some jobs that are going to change. Maybe a large number of processes are going to change. The customers might get a question mark. So that change transformation for us to force that through into the traditional business versus drive it through CVC, I think that I would say that when you say the timing is now, that AI timing is really now.
And do you think that the CEOs are up for it? Honestly, because you are basically saying, this is the greatest disruption, arguably, I guess, since the steam engine, and I wasn't around when the steam engine came around, so I wouldn't be able.
Well, cloud was big.
Cloud was big too, but this is unprecedented because we don't even know the extent. Yeah. Right, and the issue here is you got a technology which learns and continues to evolve. So, which has not happened that many times in the past. Technologies have evolved from their initial sort of drop, right? But are CEOs and businesses ready to come in and say, we are happy to entirely disrupt ourselves now because we need to be a different entity? And the second question is the business skills case still, is it stacking up? Because there's very little evidence right now which suggests that the business case stacks up for this wonderful new world which is going to be run by AI.
So I would go above the CEOs. I would say, are the boards ready?
Boards, yeah,
Are
sure.
the shareholders ready?
Shareholders ready, yeah.
And there is a J curve, which means the shareholders have to, the narrative has to be explained to the shareholders that you're going to accept a J curve if we're going to transform with AI, which goes back to your business case question, number one. Number two, the board almost have to push the management, literally have to push the management. The board have to drive the management for this, because the management, I'm not saying in our case, but in general, as a consultant having been used to this, are often stuck. They have a certain thing that works. They want to watch what's going on with AI before bringing it home.
Yeah.
But if you watch, it might be too late.
But they're all measured by quarters, and it's the same shareholders who measured them by quarter, by half
back
year,
to the
year.
J curve and a narrative discussion. So you have to go back and build that appetite in your investor community to say, dear stakeholders, this is what my plans are and this is what it's going to take. And there's some risks I'm going to take where I don't know, there's an unknown element to it, or I don't know if it's going to stack up or not. But if I don't do it, I might be out of business in 2-3 years.
And how important a role does a CVC play in all of this?
CVC is like part of the lightning rod.
Right.
I don't think it's it's probably 5% out of 100.
Okay.
Right. It's not the biggest part.
But is the first 5%, is it, as you said, the lightning rod, is it the one which will spark the light?
It helps build the narrative. It helps demonstrate the narrative. And it's a key driver of that transformation change. I don't think the good thing, and that's true in the E&, case, my board includes my chairman. So our chairman at E& is involved in our decision making as well. So they have full visibility, and this is critical.
No. So Kush, thanks for coming in. I wish you guys the very best. I have 15 down, 5 more to go, and I'm sure with everything I read about EAN and its ambition to grow, I'm assuming the CVC will continue to grow, both in terms of giving financial returns and being a strategic play. I appreciate you coming in. I think this was a very informative show for people who wanted to learn a little bit more about CVCs. I think it'll be an interesting one to watch. I think the way I see it is, at least from a banking sector perspective, I think in the last year we've seen pretty much all the tier 1 banks announced some CVC or the other, and some of them have started deploying capital. Particularly, I'm very interested from my world's perspective in terms of what they do with the post investment support that some of these early stage startups, especially for the ones who are actually coming in early. But thank you for coming in. Have a good weekend.
We have a week, hopefully.
Well, we have a week
soon.
Hopefully,
Soon.
yeah. Well, we're not time stamping the show, so we wouldn't know when we're actually going to be out. But I'm sure we're going to meet up again and have another discussion. So, ladies and gentlemen, that was Kushal Shah, who's the MD of EAN Capital, which is the CVC arm of the EAN group. He's based out of Dubai, and if you have a attractive startup which is slightly in the later stage, although A and B, seek him out. He's got money to spend, so let's get him to put that the next 5 deals.
Make Arjun go through the process filtering it first.
Well, there you go. Right, but I'm not sure that would be the best filter in the world, but hey, thank you for that. I'll take that as a compliment. But with that, goodbye, and I'll see you guys next week.